Clayton Graham is Vice President of Wellington Management. Wellington Management was founded in 1933. It manages over $1 trillion of assets. Prior to joining Wellington, Mr. Graham was VP of Global Markets at Barclays. He received his bachelor's degree in economics from Harvard, MBA from Wharton School, University of Pennsylvania. He regularly speaks to advisors like us, institutions, as well as clients on the international aspects of the market and domestic aspects. He's going to talk about opportunities as well as risks, and he'll spend some time talking to you about that. We've got your questions, by the way, gathered. And if you have any other questions that we haven't gathered, just raise your hand, and Tim or Adam or someone will pick us. If you have any, raise your hands if you could. We'll be sure and pick up those. So what we're going to do is Clayton's going to come on up, and Clinton's going to come on up, and then what we're going to end up doing is then taking questions and answers afterwards. So Clinton, thank you very much.
So first of all, thank you for the wonderful introduction. It's a pleasure to be here. That introduction was far too kind, so I'm going to tell you a story to just bring it down, to humanize myself. I started investing out of my dorm room in 1999. And if you remember 1999, those were the go-go years. I took $2,000 and I threw it into the stock market. But I didn't just throw it anywhere. I threw it into the most speculative part of the stock market, penny stocks. So things were off to a rocking start. 5 cents turned into 30 cents, and I think I'm a genius. However, I was trading with some of my other friends in the dorm room, and I woke up one morning, and he said, "Have you checked the news?" The company that we invested in was called Wellness Universe, and they were being sued. The CEO and a couple teachers from Brooklyn had run a pump and dump scheme, and the stock was now trading at zero, so the $500 I put in was gone. That would have been the end of the story. It would have been sad. I probably would have taken another decade before I started investing again, but something magical happened 3 years later as I was working on Wall Street. So I'm making pretty good money, and I'm living in Manhattan, and I get a letter in the mail. And the letter says, "We've started a disgorgement fund. We sued, recouped the money. If you'd like to add your name to the list of those making a claim, let us know." So I did that. And several months later, the $500 initial investment was repaid with 6% annualized interest. So I was now getting a check for $800. I tell you that story because where we are today reminds me of why we invest in the US. It's because it's the greatest place on earth if you're thinking about protecting your assets. But also that story reminds me that proper risk management is key. It also reminds me that markets move in cycles, and when it feels the worst, it's usually darkest before the dawn. As I was graduating and I realized that the markets had rolled over. Do I really want to go into finance? I did it anyway, and I'm grateful that I did. But the last thing I say is that it reminded me that the next time you get the bright idea to invest your own money, don't. Get yourself an advisor. Call Paul, call Tim, call Adam, and set yourself up. So that's why I'm here today. But I travel quite a bit. I speak all the time, as Paul mentioned, and the concerns I'm hearing are the ones that you know. They're all around the globe. The uncertainty in China around their zero COVID policy, the China slowdown. Will they invade Taiwan? I'm going to touch on all of that. What's going on in Russia with the Ukraine invasion? When will that war be over, if ever? And so what I'm going to do first is give you a little bit of an intro of Wellington and how we think, because Wellington started about 100 years ago, right after the Great Depression. And so we have a long history of thinking long-term and not worrying about the quarter-to-quarter gyrations of the market. So I'll give you a quick intro on that. So I'm going to take you around the world after that. Then we'll talk specifically about the U.S., recession, interest rate policy, rates, all of these things. And then at the end, I'll sum it up with, what do we see on a go-forward basis? What are we really excited about? So just to talk a little bit about Wellington, as I mentioned, it's been around for about 100 years. There are 3 things that make it unique, Its size and scale, we manage close to $1.2 trillion in assets, and that's diversified across equities, fixed income, and alternative solutions. That's important because we're not a shop that sells product to advisors. We really are in the solutions business. We work closely with our advisors to say, what's the pain point you're trying to solve, and bring a solution to them that makes sense. The second thing is we're a private partnership. So most firms are not private partnerships these days, but we are. So that means we're not publicly traded. We actually take a long-term view. We invest during times like these to attract talent that can become partners of our firm. And the last piece is that we have a centralized research function, and that function covers macro, asset allocation, and we have 25 offices around the globe. So those insights that I'm bringing to you are brought to me by people in Hong Kong, in Australia, in Europe, all across the globe. So these are their greatest insights. So where should I start? I'm going to start taking you on a trip around the globe in Europe, because the Russia-Ukraine invasion has created a wide range of outcomes. And I would be remiss if I didn't say no one knows how this ends. We get a lot of former communication specialists, people who have been in government, who say that, you know, there's the rumor that Putin might not be well, but no one can verify it. So no one really has a good, really has a good signal on what's going on there. So what does that mean? We know that prices for energy for European citizens are going to remain high, and that is going to put a strain on their pocketbooks. So that means we're staying clear of areas such as consumer discretionary, where your disposable income has been pinched. But that doesn't mean we can't find ideas in areas that are poised to benefit from the invasion. So I heard someone earlier say that they worked at Lockheed, and I don't know if you're in the room. If you've worked at Lockheed, raise your hand. All right, there are a couple. So aerospace and defense is our #1 call in Europe, because every country's budget for national defense has been increased. Germany increased it 20%. So that's one big call. Our second big call is in things tied towards decarbonization, renewables, and energy. Because what we're seeing is that every country, it's a matter of national defense. They have to diversify their sources of energy. That means wind, that means solar, that means more turbines. So we're excited about that part of the market. The last one is healthcare. Whether Europe is the most at risk of going into a recession, they've got the highest inflation. Obviously, the war is going on there. So what that means is that you need to invest in companies that are durable, that are resilient, and there aren't many sectors that are more resilient than healthcare. And so we're finding a ton of opportunity there in healthcare services and pharmaceutical giants that have strong pipelines, strong balance sheets, and that also pay a very attractive dividend. So that's what we're seeing in Europe. I'm going to take you over to Asia, and we'll talk a little bit about China, because China is what you're probably hearing a ton about on the news, and there's a lot of fear. We have a very differentiated view on that. Now, there was a Chinese National Congress meeting just about a week ago, and that sent Chinese equities spiraling downwards when they were already at fairly depressed levels. Now, the fear came because there's been a consolidation of power into the hands of pretty much several individuals. Our view is that the market overreacted. If you listen to what came out of that Congress, there was no new news. So the tech stocks sold off. They weren't even mentioned. So what you're seeing is markets are super pessimistic about what's happening there, and a lot of it has to do, the question I get is, we fear that what Russia's done in the Ukraine is going to embolden China to do the same thing in Taiwan. Would you all agree with that? No. We think the opposite is the case, and I'll tell you why. So China, the legitimacy of the Chinese National Party is dependent on them improving the lives of its citizens. If you look at what's happened to Russia since they invaded, they've actually been shut out from Western economies. China is even more linked 100% of their soybeans are imported from abroad. They're not energy self-sufficient. That means that if they were to pull something like that, they would be harming themselves almost irreversibly. So that's kind of our view on that. But even so, there are still stated mandates that China has on the boards that you can invest on the right side of their policies. So they want to do three things: clean their environment for their citizens. 2, they want to have technological independence. And they want common prosperity. And so when you think about one of those, the independence, we're going to shy away from things like semiconductors and anything linked to aerospace and defense. However, the other two, cleaning the environment for its citizens, China Longwan is the largest wind farm operator in the world. I think we can invest in that. If you look on the other end of the spectrum, a lot of lockdowns have happened, and so everyone wonders, when will the zero COVID policy be lifted? Well, no one can say for certain when, but it will be. And when it is, you're going to see inter-province travel between regions in China accelerate. That means you want to invest in businesses that are poised to capitalize on that. Tourism and leisure and things of that nature. So we're still able to find attractive opportunities. So I'm going to wrap up Asia, and then we're going to come back to the U.S., where we're going to spend most of the remainder of our time. So other pockets of Asia that we find attractive: India. So India, if you look over the last 30 years, and this is endpoint dependent because China's suffered such a strong drawdown, so we've got to let that be known, has outperformed China. So we like to say that in China, companies survive because of the government and the policies. In India, Indian companies survive despite the policies that have actually constricted them. But the upside of that is the cost of capital in India has been so high that the survivorship bias means that they're some of the strongest businesses in the world, right? Japan, in the short term, they're one of the few countries in the world that can provide both fiscal and monetary stimulus, along with China. So in the short term, they're a good bet. Longer term, they have challenges with high debt to GDP and demographics as well. So we're short-term bullish, long-term, we're indifferent. And then I'd say the Southeast Asian nations, you know, the US dollar is something that we need to touch on. Historically, if the dollar had been as strong as it is today, you would have seen many other emerging market countries their currencies get decimated. But they've learned from their past mistakes. They've diversified their reserves. They have stronger protections in place. And so basically, they've done well. The other thing about Southeast Asian countries is that they're innovating at a faster rate than just about anywhere in the world. And as you know, innovation is the key to productivity improvements. So from that respect, they're going to benefit from innovation, but they're also going to benefit from diversifying away from China in order for companies to have a more diverse supply chains, which we learned was very important after COVID. All right, so I've hit on, you know, just about most of the regions. I'm not going to talk about South America, even though, you know, I think Brazil is the most poised to benefit from Russia being disintermediated from the Western economies, so I'll let that be known. But now let's come on over to the US, and let's talk about recession, inflation, rates, and elections. So if we start with recession, I think you all have a Capital Group booklet on the table there. And in that booklet, what you'll see is, you know, how do we determine whether we're in a recession? There are a couple different ways. So some people look at the yield curve. Some people focus on consumer confidence. Some people focus on housing, and there are various factors. However, all of those are lagging. So even as they begin to roll over, it'll be 4 to 12 months before you actually hit a recession. The one that a lot of folks have looked at more recently is the yield curve once it inverted. And on average, that's going to be about a 14-month lag. But every time the yield curve inverts, it doesn't necessarily mean that you're going to go into recession. That's what they never tell you. It usually happens, and then the recession happens way out there. So we have a differentiated view. And the most controversial thing I'll say today is that we don't think we're headed for a recession. I'll say it again. We don't think we're necessarily headed for recession. If you look at the pundits on television, you would think it's with 99.9% confidence that we're headed for a recession. The most interesting chart that I've seen is one that just showed corporate profits as a percentage of GDP, and on the other panel, it showed compensation as a percentage of GNP. And you saw the corporate profits are high relative to history, but compensation is at the lower end of the range. And if you understand what the Fed is trying to do, it's trying to tamp out wage inflation and bring down real estate. And we think that there's a little bit of a lag. Rates have risen so high. You heard the statistics, mortgage rates of 7%, all of these things. It's coming. And we think that in the first quarter of next year, what you're going to see is the rate will have its effect. In the tech industry, you're already starting to see a lot of hiring freezes, outright layoffs. In the financial services business, just about every major bank, insurance company has put in a pause. So we think as the data starts to trickle in, you're going to see the Fed come to the realization that they've done their job and that they can pause and take a wait-and-see approach. So now, I'll talk, one of the things we do think is going to come about is, unemployment. We don't think, this is a huge problem because we've lost a lot of folks in the labor market for a variety of reasons. Both of my parents turned 65 within the last 2 years. They both work in the medical profession. They would have kept working for another 5 years, but the COVID made their jobs such hell that they said, I'm not going to do it. We've lost a lot of people. We don't know where all of them have gone. So unemployment, while that's usually what happens in a recession, the labor market is so tight that it's not going to get as bad. Now, I know that a lot of people say we have to get to 6% unemployment to get rid of inflation. However, a lot of the inflation is already coming down on its own. Some of it will be stickier in certain places than others. But I think that the Fed can pull off, and I know that there are a lot of Boeing folks in the room, so they can stamp out inflation without ruining the economy. They can pull off that soft landing. So the last thing, a couple things I'll talk about are taxes and then the elections. No one's talking about the national debt, and with rates as high as they are, that's going to be a big bill for us to pay. So what does that mean? We're either going to have to increase taxes or cut spending. Do you think any of the politicians have the gumption to do either of those at the moment? I don't, and so I have no faith. So then that takes us to the elections, right? In our view, the most likely outcome is gridlock, and everyone in this room should be rooting for gridlock, because if you look at the returns during a midterm, when you have what we like to say is what's on the menu is a lame duck presidency. When you have a lame duck presidency, you get a roaring stock market. And so where we are right now, being down 18% on the S&P, sets up very well to have a nice bounce from here right up until the next election. So one of the things that I'll say, and then I'll take some questions, is how do you navigate these markets? Well, I think it's really, as a firm at Wellington, we take this long-term view. We're very contrarian. There are a wealth of opportunities in fixed income with where rates are right now. To begin the year, the big conundrum was, gosh, how do I protect against downside risks? Where do I find yield? Well, you can find yield in fixed income now. Within equities, there are a lot of high-quality, durable, resilient businesses that you can invest in right now at a very attractive price. And then when you think about downside protection. It's really about being nimble and opportunistic. I've been traveling all around, and I can't think about an asset class that isn't looking at way better today than it did at the end of last year. So one of the things I always say is I never look at my statement, right? Because if you looked at your statement at the end of last year, you thought, oh my gosh, I'm doing so great. And then you looked at it today. That's all endpoint dependent. We all suffer from recency bias, right? If you looked at your statement, at end of last quarter, you're like, oh gosh, I've lost so much money. But if you just take a longer term perspective and look at how much the markets have run over the last 10 years, you realize that, like I said in the beginning, markets are cyclical, focus on risk management, and talk to your advisors. So I'm going to pause there and see what questions you all have.
We have some great questions, and Adam and I are going to filter through the questions that we've received, and if we have time, we'll obviously take some questions at the end. There have been some questions related to asset allocation and things like that. That's something more specific that you would want to talk to your advisors about at your meetings. So there are some questions that we may not get to more specific to your specific plan, but some of the general questions that are consistent, right, through what Adam and I are seeing, we'll definitely address to Clinton. So first one, Clinton, is this, where do you see the housing market, and how does that play into your viewpoints of recession, possibly?
So the housing market is an interesting one because obviously we've seen a lot of appreciation in home prices driven by extremely low rates. But on the flip side of that, there's been such a supply-demand imbalance that there are not enough homes. The other thing that's happening in that market is builders have a lot more capital discipline, meaning that they know that if there's a potential for recession, we probably shouldn't build homes right now. Let's wait it out. Now, the last recession driven by a home crisis, we're not going to see that because basically most households have gotten in at a very low rate. So what does that mean? It means that they're not going to be looking to sell in 5 years. They're just going to end up staying in that home probably for the majority of the term of their mortgage. And so we don't think that there will be a catastrophic event in that part of the market. And we don't see prices coming down too significantly because of that supply and demand imbalance. So, you're going to see less sales, and that's what the data is showing us today. But in terms of 20% down market, maybe in some of the frothiest parts of the market. And then you have commercial real estate. One of the things everyone feared just 6 months ago was that everyone was working from home. So what would happen to commercial real estate when all of those office spaces are lying dormant? Well, what you're seeing now is just the prospect of recession and the prospect of hiring freezes means that anyone who's working at home might want to get a little bit more face time with their boss, might want to come into the office, get off, take off the PJs on the bottom, put some slacks on, and get into work.
Perfect. And then next one, and we have a few questions on this, but I know you spoke briefly on the elections, but kind of a little bit more specifically, we got the midterms here coming up, and considering if there's a change in the makeup of Congress, how do you see that affecting markets one way or another?
So here's the thing. I think regardless of what happens, because the one outcome that's almost not possible is Democrats having both chambers as well as the presidency. So I'm not even going to touch on that one because I don't think it's a possibility. The most likely outcome is split, but each day it's looking a little bit more and more like it could be both chambers for Republicans. And so I'll talk about those two outcomes. If it's complete gridlock where it's just a lame duck presidency, Biden's not going to be able to push through any more policies that are had been stoking a little bit of inflation, right? So Inflation Protection Act was not actually an inflation protecting act, and so I don't know if Biden got that, but it wasn't. And that's not a political statement, it's just a fact. And so, but if you get the split, then he will have the ability to continue doing some of those policies. However, on the flip side, if we go back to the converse where Republicans have both chambers, they actually are going to start opening up a lot of inquiries, into all of the different things that have been rammed through. So you could start to see the repeal or pullback of some of the policies that Biden has been able to pass. Will that be good for the market? I think initially it could be. It could be to the effect that gridlock is good for government, because while they're doing all of that, we know the rules of the road, we know the lay of the land, and you could just go ahead and invest in businesses focused on fundamentals instead of worrying about what next policy is going to change down in DC.
Great. Another question, Clinton, is regarding the situation going on in the UK, right, with obviously multiple prime ministers and obviously the British pound obviously falling pretty dramatically, and also the other things related to the strength of the U.S. dollar. So if you could speak to the things going on in the UK, do you see any contagion effect possibly going to us here in the U.S., and also the effect of the strength of the U.S. dollar?
So the big news alert was the LDI crisis out of the UK that was precipitated by the change of their policies with respect to rates and with respect to trying to give tax breaks. So I'd say that in general, US banks are the best capitalized banks in the world, bar none, in insurance companies also. So what you had is a situation in the UK where in the search for yield, a lot of insurance companies had put on a little bit more leverage than they would have liked. And as a former risk manager at Barclays, I know that leverage is a double-edged sword. It's great on the way up, but it will hammer you on the way down. I think that there's not much of a chance of contagion because the bank, there have been rumors about Credit Suisse, there have been rumors about all of these other banks that may be impacted by that. Most of the US banks are really well run. You think about a Goldman Sachs, you think about a JP Morgan, they have stable leadership at the top. When you look at a Credit Suisse, they had seen a revolving door of leadership at the top, which has just weakened their ability to manage risk. And like I said in the beginning with the story about how I found my way into finance and investing, risk management is absolutely key. As it relates to the US dollar, the currencies move with rates, right? So the UK is going to have to solve its inflation problem, and so while they're behind the US on that, and many of the developed world is behind, Australia put a pause on raising rates, the UK, but they're slowly coming to realize just how important it is to be tough on inflation, because if you don't, the market will let you know that you made a mistake, and that's what we saw in the UK. Now, I think that they're back on the right course. Will new leadership be able to steer them in a new direction? I'm optimistic that they'll get it right this time, or at least they'll know that the market is watching, so they can't overreach.
Yeah, we have, again, a few different versions of this question, but the gist of it is, considering the current interest rate environment and, bonds have obviously taken a hit in this environment, I guess how should investors be thinking about those in their portfolio today? Yeah, so essentially, considering the interest rate environment and how bonds have taken a hit due to that, essentially, how should investors be thinking about bonds in their portfolio today?
Bonds are back. Bonds are back. So, obviously, you want to have a diversified portfolio. But right now, when you think about being in cash, if you have cash sitting on the sideline, you're getting an extremely attractive rate relative to where we've been for over a decade. So bonds can once again play that critical role. There are three things you're looking for from any asset class. You're looking for a return enhancer, you're looking for a diversifier, or you're looking for a risk mitigator. And those two roles that bonds have historically played as diversifier and risk mitigator, they now make sense again because you have actual cushion in terms of your rate. More so, and that's also one of the reasons why we believe that the Fed can pull off a soft landing, because with rates where they are today, if they do make a little bit of a hiccup or a misstep, they have the ability to bring down the rate, and when rates go down, bonds go up. So bonds are back.
Great. A couple of other questions, Clinton, center around inflation. So, and you mentioned in your presentation that you believe that inflation is coming down. So I guess one question is, do you believe we've experienced peak inflation? And second of all, where do you see inflation settling out in the long term when this is all behind us?
So I'll start with the end and then work my way backwards. So Dewey Dewan, who's one of our preeminent macro strategists, says inflation will be down to 3% by the end of 2023. So that's our target. Now, how do we get there? Inflation is not peak everywhere. So if you looked at the jobs report and employment, you'll see that the labor market is still tight. People are still getting raises on average, like close to double digits in some pockets. Luckily, that's not for many white-collar jobs. That's for many blue-collar jobs where it's hard to find cooks, it's hard to find bartenders, it's hard to find people in the service industry. So services inflation, because of the lack of, we lost so many people in the labor force, and many of them aren't coming back. And so that's the hardest part. So some of it, but when things that were caused by supply chains, we see those loosening up, especially the minute China gets rid of its zero COVID policy. So we think inflation going to be a little bit sticky in some parts. On average, it's going to be coming down. So the headline inflation will be precipitously declining throughout 2023.
Perfect. And I know you spoke briefly on the China-Taiwan thing, and you don't expect China, to go after, Taiwan, due to the Russia scenario. But kind of in regards to the semiconductor issue, do you expect any retaliation from China at all?
So basically, China is in a position right now where they've been dealing with the zero COVID policy. They just got done with the National Party Congress, where it was like a scene out of The Godfather, where there was a consolidation of power. And so basically, they have had a lot to deal with, and they still have to come up with their 5-year plan. We don't believe that they're in any position right now to be antagonistic as it relates to international affairs at the moment, because they're still dealing with lockdowns. And I think they really need to focus inward, because I have friends that live there, and some of them that were in Shanghai when lockdowns were in place. It's like all of us, when we were on lockdown for 9 months to a year or however long we were, they are losing their minds. And so that they really have to find a way, whether it's through getting better vaccines, whatever it is, they have to come up with a plan to get back to normal. And I think that's their focus. Now, the question we always get is, what about those military exercises that, the show of force and that around the island? And so we have a gentleman named Terry Tian, who is on the ground in China, and he's a research analyst there. And he says, that's really meant to be a signal to anyone inside Taiwan who has any illusions that they could change the status quo, and not necessarily pointed at the U.S. And so they just want to maintain the status quo. And so I feel for those reasons, it's very similar, that China is, for the time being, going to play nice, if you will.
Yeah, and we've got some other questions, Clinton, on the Social Security, Medicare system, and the impact that has on all of our lives, especially the planning that we've done for a lot of folks in this particular room. So, where do you see viability of the Social Security system, Medicare, and how do you see that changing over time?
Yeah, I mean, that is the preeminent thing that is going to be one of the toughest challenges going forward for any for the foreseeable future. We think that there are going to have to be some concessions made because, as I mentioned to you, our national debt and the ability to service it is going to come with some cutbacks. We see that being the biggest fight between Republicans and Democrats that no one's talking about, because as you know, each year that goes by, it becomes a bigger and bigger issue where if changes aren't made, we're going to find ourselves in a situation that is irreversible. And our view long term is that in the next 4 years, and this will be a big election issue. However, right now, things are intact, and things, 20 years out don't look great, but if we get ahead of it, it's kind of like climate change, right? We know it's kind of happening, but we don't feel it right now. It's getting a little warmer. It seems that things are getting bad, but there's always a tipping point, and as long as we get ahead of that tipping point, we'll be in good shape.
And I'm combining two separate questions here, but just in regards to the Fed increasing interest rates, I guess how much further do you see in them increasing interest rates? And also, separate question, how high do you see mortgage rates going?
Yeah, so we see terminal rate about 4.9 to 5% from the Fed. So that, mortgage rates is anyone's guess because that is really going to be dependent on a lot of other factors as well. But they could get as high as 8, and that would obviously be on the higher end of where they have been historically, because this has been one of the fastest acceleration in interest rate rises in history. However, we see that in the first quarter of next year, there will be a pause. And if the data keeps coming in showing that inflation is coming down, the Fed has 2 mandates, and they will be squarely focused on employment and as interest. And so then we're not calling for rates to start coming back down, but we are calling for a pause, a readout of data over time, and a moderation of rates. And at that point, you'll see things start to stabilize.
Great. A few other questions center around the inflationary question. And so what do you view being the biggest contributing factor to inflation? Is it the easy money policy? Is it the Russia-Ukraine geopolitical tensions? I mean, what are the factors that you feel play most specifically into the inflation so far that we've experienced?
It was the easy money policy by far. I mean, if we looked at the money supply, the supply of money prior to the pandemic, but we had loose monetary policy after the GFC, so the monetary base expanded then, but it was maybe a 1x. After COVID hit, it exploded like 5x. So that's where we saw speculative assets like Bitcoin, cryptocurrencies, companies that didn't make money. The world was so awash in cash that every investment looked good because your cost of capital was 0. So that's exactly what happened. But on a go-forward basis, what you're going to see is more of a focus on fundamentals, strong balance sheets, cash flow generating businesses. And that's all good for companies that make real money, companies that own hard assets. Companies like some of our, like a Boeing, like a Raytheon, like, all of these companies in the US that make great products and can sell them abroad because they actually add value and turn a profit, those are going to be some of the businesses that become in vogue again.
All right, a few other questions here, and we'll finish up. But your view of the national debt and how that plays into potential growth for the U.S. economy, and do you feel that at any point being, a contributing factor to problems moving forward in our economy?
Yeah, so the national debt is only a problem if you can't grow your way out of it. So if we were able to increase the growth rate of the economy, increase GDP, we wouldn't necessarily, being the reserve currency of the world, gives us some liberties. All we have to do is grow at a faster rate than the interest that we're paying. And so the problem is that we have, for a variety of reasons, been shrinking. So in terms of our workforce, we can increase the workforce by raising immigration, better childcare options, so both men and women are out working, reducing the incarceration rate, dealing with the opioid crisis. There are a lot of things that we could do that would increase productivity or the growth potential of the economy, but we haven't. And there's not a lot of political will to get past a lot of those issues that I just mentioned. But there's another way that you can get yourself out of that, and that's innovation. Innovation is the key to increasing productivity per person, and the US is the most innovative place in the world. So I'm optimistic that if politicians don't get it right, the geniuses in Silicon Valley will figure out a way to make us more productive. We've already seen that working from home worked during the pandemic. I know that I was doing 3 times as many meetings from home as I did in the office. I mean, I hope I was 3 times as productive. So I think that the debt will be a talking point. There will be some concessions that need to be made, whether it's increases in taxes or cuts to spending. But only time will tell exactly where that's going to come from, because I don't think there's much political will today. But if the makeup of DC looks different in 2024, then we could make headway on some of those areas.
And we did get a last second question here. It's a follow-up to your question about banks. I'm not sure, do you want to ask this one just straight up? Okay, yeah, so it's essentially, you're talking about the health of the banks and that sort of thing, but what about the banks that are allegedly freezing out petroleum development by refusing to loan out funds? How would you?
So yeah, so read the question again. Is it? Am I getting it right that what about banks that aren't catering to energy companies or petroleum?
Yeah, exactly. Yeah.
Okay, so yes, so basically, I don't know that exactly what banks you're talking about, but this goes with the topic of ESG, sustainability, and woke capitalism, and all of these things that you hear in the news. The preeminent view in a lot of banks, and I'm not going to name any names, is that long term we need to move towards a greener future, and that thus the long-term prospects for petrol or energy, crude, is not something that is going to be long-term attractive. And for ESG reasons, they have certain considerations or check boxes that in order to be put into some of their funds, they may get excluded. And basically, that comes down to choice. Not every bank, there are only a handful of banks that would do that. And usually it's fund specific. It's not a broad brushed no or yes answer. So I think it's a little bit more nuanced than that. But over time, what you're going to see is less capital chasing energy. But if you know anything about diversification, all of those banks that didn't have exposure to energy this year underperformed, because for most of the year, energy with the rising prices was the only place to hide out in these markets, was the outperformer. So there's always going to be capital that is return seeking, that is going to say this is a supply and demand imbalance in terms of the investment in this type of energy. So whoever is willing to take the increased risk will see increased reward. So markets are pretty efficient in that regard. It's just that the hurdle rate for an investment in crude has gone up.
And then the last question from the audience that we've collected would be, your viewpoints, Clinton, on the benefits of a diversified portfolio, right? The classic bond stock portfolio, is long-term, is there benefits that you see specifically to that, and obviously how that plays in a well-designed plan?
Yeah, so like I said, Wellington founded the first balanced mutual fund about 100 years ago as the Vanguard Wellington Fund. It still exists today. I think 50 years from now, it's going to continue to exist. It's proven time and time again its durability, so it should form the core of your portfolio. You should have 3 to 5% metals and mining. That's great because it's uncorrelated with equities and fixed income, and during times of inflation could be great. So, having a little bit of gold in your portfolio is great. Having some commodities exposure is great. Diversification is the only free lunch, but at the core of it, where you want to put the bulk of your assets, where you can participate on the upside with the equity portion and get an attractive return. We know that over time, you should expect about an 8% return. And then you supplement that with something that is a diversifier and provides downside protection with your fixed income assets. That's great. So that should be the ballast in your portfolio. And then you have a small amount around that, whether it be commodities, materials, or infrastructure plays, maybe small sliver of private investments if you're able to. All makes sense. And so I think that's the way we see it. Diversification is the key. Have a long-term time horizon, rebalance those portfolios, because what goes up sometimes retraces. So being able to not catch the full force of a momentum reversal or a fall is good. So the 60-40 helps do that for you.
Great. So that's the end of our collected questions, but there's still a few minutes for other questions that might have come up through Clinton's presentation. So we have one over here. So.
My question to you is, do you see Korea having any effect on the world economy?
Korea is one of the most innovative countries in the world. How South Korea is innovative. North Korea is really just, they're a distraction, and I don't think that most people make investment decisions based on what they do or do not do, because I know that today they may have fired off a few missiles. That's just, consider those fireworks.
So I grabbed the microphone from Tim. So the question I have, earlier on you said that's not a political judgment, it's the facts. So this is the spirit of this question. There's a lot of yammering about how the economy and capitalism depends upon a healthy, robust democracy. Is there evidence? Are there facts to support that rather than political statements?
So I think at the end of the day, when you think about democracy and what it's been able to do, it's been able to bring everyone into the tent and get people on board with a common mission of, if you're really good, you work really hard, you provide a better mousetrap, you're going to survive in the marketplace of ideas. And I think we've proven that as a society, in that some of the very best ideas have been generated right here in the US, because you can have a crazy idea and you can go out and you can execute it, and if people are willing to support it, you'll succeed. So I don't know that there's hard evidence, other than if you look across the globe and you look at, there's an index called, free capital, how liberal or capitalism is in your specific country. So for instance, before China reacquired Hong Kong, Hong Kong was one of the most open societies. That was the preeminent free market capitalist place on the planet. And if you've seen what's happened since it's been taken over by China, that's actually going in the wrong direction. And so the US, democracy is key because freedom of speech is key, having open and honest dialogue is key, and having any one political party. Well, this is why a lot of folks are scared of China, is that there is no open debate. There is no open dialogue. If you dissent, your voice gets stamped out. So the beauty of democracy is the inclusion that it brings. To have someone like an Elon Musk come to the US and decide, you know what, I'm gonna build an electric car, and someone somewhere else might have said, that's crazy, you can't do that. But he's like, I could do that here because I can get the capital. Someone's gonna take a risky bet on me, and then I'm gonna do it again and say, I wanna send rockets up to the moon, and he was able to do that again. So you need those outlier geniuses to think that they can do, say, and be anything they want to be, and you can't do that unless you have a democracy.
Great. So we have time for a few more questions. We have one over here.
Hello. Looking maybe 5, 10, 15 years out, I'm concerned about global political instability and the impact of climate change, sort of on the economic system of the world. And
Yeah, no, those are two important points. I think that the one place where if you had to put a bet on where the next trillion-dollar company is going to come from, it's going to be related to decarbonization, so cleaning our environment. And then tangentially related to that, the issue we're going to have in pulling off a greener future is deglobalization, to your point, is that we're moving a little bit further apart in the sense that it's becoming a bipolar world. And that's why we're racing in the US to reshore manufacturing here in the US, partnering with our allies, because there's slowly going to be a little bit of a drifting. You know, one of the portfolio managers at Wellington says that we'd been benefiting from a peace dividend for the last 30 to 40 years. And for the next few years, the next decades, we're going to have to really look inward and reinvest in our businesses here in the US, build out our manufacturing, use robotics and artificial intelligence to gain an edge, and that cyber is going to be where the next war is fought. But notwithstanding right now, that's 5, 10, 15 years out. For now, I think we're really focused on where we see the world going over the next 3 to 5 years.
Great. So we'll wrap up our Q&A with one more question here.
Of all the alternative energy development programs that we have, there's one you don't hear much about, and that is hydrogen. Because the exhaust feature of hydrogen is H2O. Is it a costly development why you don't see it? Because it's very energy efficient.
You're absolutely right. It's one of the more efficient forms of energy generation. And the costs are going to be below energy by 2025, crude oil. So what you see with every form of alternative energy has some drawback. If you think solar, what do you do at night? If you think about wind, what do you do when the wind's not blowing? So there's a couple ways around that. Where do you store it? And I think the problem for hydrogen is transportation and storage, as it is for many other forms of energy. So definitely the cleanest, but the hardest to get around technologically in terms of how you implement it into our existing infrastructure. And that's the biggest problem. And then how do you mass produce solutions using it? It's not that it's not the cleanest. It's definitely right up there. I actually thought you were going to say we never hear about nuclear anymore, but you actually talked about the one that is definitely talked about the least. But it's going to be part of the solution because there's no one magic silver bullet towards whether energy independence or a green future. It's going to take everything we've got, including nuclear, wind, solar, hydroelectric, because the problem is too great.
Great. Let's give Clinton a big hand.
Thank you.
Thank you, Clinton. Excellent job. Appreciate it. Okay, hope you all enjoyed that. So a couple of things. Just one clarification or one kind of insight that we got as an advisory team. Someone asked a question about bonds, and just to give you an idea of one thought. This was from a money manager as well that we work and track with and actually met with. If you think about it, bonds have been in this, as Clinton mentioned, bonds have been in this very difficult position right now, one of the worst bond markets in decades. Well, bond values are very low, but think about this, and this is exactly from one of the money managers that most of you have in your portfolios. What he was telling us, he said, what I'm able to do right now is get some screaming deals on bonds. In other words, I can get a 3-year bond, for example, that's with a high-quality company, call it a Procter & Gamble, Colgate-Palmolive, a corporate bond, but I can get it for 85 or 90 cents on the dollar. It's a 3-year bond, and it pays, say, 5%. So if you think about it, 3-year bond, 85 cents on the dollar, what you're getting is a 5% appreciation each year. Again, going from 15% to 10% up to par. Second of all, you get a 5% coupon. So you're basically getting a 10% yield on a corporate bond. So just remember, there's opportunities all over the place. The other question to think about is inflation. It comes up all the time. Clinton did a great job at explaining it. Many of you are familiar with what are called I-bonds. Familiar with I-bonds? Okay, so I bonds pay basically are inflation-adjusted bonds, but they pay a rate of return as an interest based on the last 6 months of inflation. Anyone know what the I bond rate was for the last 6 months? Over 9%? Anyone know what it is for this next 6 months? 6. So it's kind of interesting. You say, wait a minute, isn't inflation higher? Well, think about what happens, folks, is that inflation that we just came through was really high for the 6 months prior to the last 6 months. But this last 6 months, inflation actually, core inflation has come down. Labor's still up, but goods inflation's come down. So that's why the I bond is paying less for the 6 months going forward. So there's certain indicators just to let you know that we watch very carefully, that really exactly what Clinton said that we build into your portfolio. But this is one indicator to let you know that inflation is, does it mean it can't go up anymore? No, it doesn't. But it just shows you some of the indicators that we're talking about and looking at. Well, before we wrap up, what I'd like to do is have Tim just talk a bit about a new program we're rolling out as part of our PEAK process, and PEAK stands for PEAC, Planning, Education, Advice, and Consulting. That's a trademark process that we have that we developed. Really, it was birthed out of providing more tangible services to you that are nearing and in retirement. That's where the estate transition comes in. That's where continuing care consulting comes in. So, and it's all about education, all about planning, all about advice for those folks, frankly, age 50, 60, 70, 80, 90, and our oldest client was 104. So we're waiting for someone to beat that. Anyway, Tim, why don't you go ahead and talk a bit about that process and that program we're looking at rolling out this 2023.
Sure. Thank you, Paul. Yeah, no, we're very excited. We're always looking for ways to enhance and improve our ways of communicating and getting information disseminated into you in effective and efficient ways. And so over the last number of years, right, we've been dealing with the COVID, the shutdown, the means of meeting with a lot of you. As you know, a lot of it has turned from meeting in person to virtual. And so we've really kind of, I won't say perfected, but we've gotten very good at the virtual communication piece. And so, again, in a way to enhance our services, Paul mentioned the PEAK suite of services, which a big part of that is education. We're rolling out what I would say is our client education series of virtual events. And so our planning is going to be 3 events, one each quarter, on various topics, various points of interest. It could be age-related, like I'm turning 62 and looking at Social Security options. So one of them might be very well on what do we do? Do we take our benefit early? Do we wait? Might be, hey, I'm turning 65 and I've got Medicare decisions to make. What's the most effective way of taking advantage of the plans that are out there, whether it be a traditional Medicare plan or an Advantage plan? It could be situational points of interest. For instance, estate planning, the do's and don'ts of handling an estate when somebody passes away. So we're looking at all these various topics that we think will be very timely and very informative, and I think very helpful as well. And so, like I said, we're planning on having 3 events next year in this virtual context. It'll be delivered via Zoom. You'll all be getting invitations to these events throughout the year, and then capped off with our event like we're having right now. So we'll have 4 events throughout the year. This event obviously is always the culmination of what we offer, but we're very excited about this education series that we're rolling out.
Thank you, Tim. And our whole goal is to empower you with information that's going to help you in each phase of your life. And this is information that we all talk to you about in your individual meetings one-on-one. So what we want to do is bring this together it doesn't replace that at all, but it does give you that are looking at getting more information the opportunity to be part of a program as well. And you'll see more information on that, and there'll be plenty of opportunity to sign up. And we're likely going to do this on kind of an ongoing basis, and we'll bring other topics as well. If you have any topics you'd like to suggest, feel free to email Tim at timk@paulried.com as well. So let me go ahead as we wrap up and give you 4 takeaways. I always think it's important to kind of be able to put things in maybe a summary fashion. You've got a lot of information. Hopefully you've enjoyed it. this is kind of a combination of things we'd like to leave with you. First of all, there is disputes about whether we will be in a recession or not. So the first takeaway is let's look at the facts about recessions. Let me read some to you. Because there may be a recession, and you're going to hear these words, they're emotionally charged, but let's really talk about recession. First of all, what is a recession? Recessions are natural and a necessary part of every business cycle. First of all, think about that. Over the last 70 years, the U.S. has been in an official recession about 15% of the time. 1 or 2 times in 10 we're in a recession. We've made it through all the times. Second of all, or third, the strongest stock market returns actually occurred during the late stages of a recession. See, what happens is the stock market precedes a recession. Typically, stock market declines precede a recession. It's happened, if we have one. But also, in the other side, stock market increases also. So when you know you're out of a recession, the stock market's already telling you that. So also what happened is, think about this. Statistically, here are the facts. Since 1950, there have been 11 recessions. 1 year later, a full 10 of the 11, you've had positive numbers. Only 1 year later did you not. Anyone know what the average return was 1 year later of all those 11 times in the S&P 500? Plus 29%. So we're not suggesting that that's a guarantee. Of course, it's not. But if you look at the facts, look at statistics. So number one, the facts about recession, that's one of the takeaways. Second takeaway is don't let the media or well-meaning friends or other professionals in the industry that we're in tell you there's something different you can get that's better. Because let me tell you something, there always is. Back in 2020 and 21, who would have loved to be an Amazon stock? Well, right now, they're going to tell you that get interest rate. Interest rates are great, and they are. But think about what I just told you about bonds. So just remember, be wary of well-meaning friends, relatives, and other professionals. They don't necessarily have a strategy. They might just necessarily have some observations that might not be well-founded as well. Because we have a strategy, as you know, that's birthed out of 3 decades of working in this industry and working with many of you for long periods of time. It's a proactive approach. We're actually not trying to necessarily just soften the dampening the blow of the market. We're trying to make sure we take advantage of opportunities like we talked about with your portfolio as well. That's number 2, don't let the media. Number 3, I've just entitled Learn from the Experts. So let me tell you what Warren Buffett, John Templeton, John Kenneth Galbraith, with his economist, passed away, economist decades ago, and even what Mark Twain has to say about recession. This is what Mark Twain says. Mark Twain says, history doesn't repeat itself, but it oftentimes rhymes. We've come out of them all the time. What Warren Buffett says is this. He's talking about recessions, talking about declining markets. Warren Buffett says, the stock market, listen to this. Stock market is a device to transfer money from the impatient to the patient. Think about that. He goes on to say that a market downturn doesn't bother us. This is about, by the way, his Berkshire Hathaway fund. A market downturn doesn't bother us. It's an opportunity to increase our ownership of great companies with great management at good prices. It's not just Warren Buffett. That's what the managers, that's why we use actively managed funds, by the way, because they're actually doing that. Rob Arnott. Rob Arnott manages research affiliate, manages some of the funds that many of you have in your portfolio. What he says is in investing, I think this is important too to think about, in investing, what is comfortable is rarely profitable. John Templeton, I said this at previous events before, but I think this rings true. The 4 most dangerous words in investing are, this time is different. John Kenneth Galbraith. We've talked a lot about forecasts. You're going to hear forecasts forecasts all the time. Interest rates, now Fed came out with a 75 basis point increase this day, it's expected. And then you can see the Wall Street Journal and others, prognosticators forecast. But let me tell you what John Kenneth Galbraith says, an economist, by the way, about forecasting. He just says the function of economic forecasting is to make astrology look respectable. Well, my fourth takeaway is what should you do now? Very simple. 4 items. What should you do now? Number 1 is stay calm and keep a long-term perspective. Number 2 is maintain a balanced and diversified portfolio consistent with your objectives. See, the times that folks get off balance, if they get too concentrated one way or the other, and they might do it for various reasons, fear of missing out or fear of loss. Next, what to do now, remember we have a proactive approach on your behalf within the foundation and growth. So we've talked to many of you in our meetings about how we're managing through this with the idea of making sure on a backwards basis that we've done a good job relative to various indices. And then on a go-forward basis, understanding what the season of the economy is like, making sure that we're positioned appropriately. Now, naturally, there's no guarantee that we're going to achieve all those results. But our goal is, as your investment financial advisory team, is to make sure we do the best we can in that area. And then finally, the last part of this and what to do now is contact us if there's any change in your objectives, and that includes risk temperament. If you're feeling concerned, because I don't know what's going to happen tomorrow, next year, next week. So we're working for you. We're your advisors. We're your consultants. You pay us to do that. When all the information, education, that's part of what we built into our process. So just recognize that we're here for you, even between our meetings. So we're your consultants, and if anything changes, we really want to be responsive, or maybe it's just reinforce what we've just talked about. Sometimes clients will call us and say, I just want to hear it again. And that's okay. Well, it's been our joy in hosting this. It's been a pleasure to see you all here. Want to give yourselves a round of applause because we are thankful for you. So thank you very much for your attendance. You take care and have a good afternoon.